Rochelle, you might think it's a bit premature to go on a diet right before the holiday season here in the United States, but the world's biggest bank got so big rescuing the world's biggest economy all those years ago. Well, now it needs to slim down a little bit. The time is right. The US economy is growing. Unemployment is at historic lows, and the projections and the numbers look pretty good for the next year or so, even if growth is fairly modest. And yet getting the timing right to wind up the biggest stimulus program in US history, well, that's the tricky part. During the global financial crisis nearly 10 years ago, there was an awkward and clunky phrase that seemed to be everywhere.
Quantitative easing.
Quantitative and qualitative easing.
We need more quantitative easing.
In the US, quantitative easing meant the US Federal Reserve buying back its own bonds and even propping up the housing market, all to pour money into the US economy and stop it from collapsing. And the Fed splashed out like never before. Before the financial crisis, it had just over $900 billion on its books. Now it's $4.5 trillion. If you could buy an actual economy with that, you'd be able to snap up Germany and have enough change for the Netherlands. Now the crisis is over and the US economy is growing again, the Fed is ready for a little bit of slimming.
We're working down our balance sheet because we feel that's stimulus that in some sense is no longer needed. So the basic message here is U.S. economic performance has been good.
The Fed plans to allow most of the bonds it bought to mature, so they effectively disappear off the balance sheet over years and years. But some say that's far too long.
The Fed right now is far bigger relative to the rest of the financial system than it used to be. And the reason why that matters is because you don't want a central bank to be any bigger than it has to be to do its job of regulating monetary policy, because if it is bigger, it's controlling a much larger share than necessary of the public savings.
But when the Fed tried winding down its stimulus a few years ago, markets panicked. They flourished under quantitative easing. If the economy is growing and stock markets are doing well, why not just leave the balance sheet alone?
Central banks aren't in the business of ordinary credit provision. If they are operating big balance sheets, though, they are commandeering, as it were, credit and using it for whatever purposes they are willing to use it for. Right now, that means funding the Treasury and propping up the housing market.
Not for much longer. Yellen plans to start shrinking the Fed's balance sheet in October. She thinks this process will be as exciting as watching paint dry. And that's as much drama as most central bankers like. Watching paint dry, Rochelle, I think that's a bit unfair. Central banking has been quite exciting these last 5 years or so, or even these last 10 years. But that's the point. Janet Yellen wants this whole program, this winding down this stimulus package, to be painless, to be so innocuous that you wouldn't notice it. Having said all that, she has warned that should things go a little bit awry, maybe they would have to stop unwinding this stimulus package and put a little bit more stimulus back into the economy. And that could be problematic, certainly from a messaging point of view. You and I have both heard over the last 2 years or so the Fed being fairly clear on when it's going to raise interest rates, when it's going to wind down this stimulus program. And it can panic markets if suddenly the Fed has to change course because the economy is changing and actually start up or perhaps continue this stimulus program.
Indeed. Now, Owen, what impact will all this have on consumers?
Well, hopefully not an awful lot, and that's the idea, really, by making these incremental changes, letting these bonds mature and letting this sort of drip back into the economy. The idea is that consumers wouldn't notice, and perhaps they would notice for the better. In theory, there should be a bit more money, perhaps, for banks to invest, maybe in infrastructure or investment projects and that kind of thing. But, of course, the Fed can only try and reassure the markets to an extent. It can only signpost these kinds of things. And it was very telling, really, that Janet Yellen had to put out this warning that maybe, just maybe, if things go awry, they would have to continue this stimulus program.
Certainly
Rochelle.
Something to watch. Owen Fairclough there reporting for us.